Hi, Damian Cullen here with the Cullen Financial Planning April 2015 market update. First thing I wanted to talk about this month is the news and the discussion around superannuation. There's been a lot of talk about changes to super and the government needing to fix their budget. The thing that I think is likely to be the outcome here is that we're not going to see too much change. If you look at these sorts of changes politically, governments are loath to make decisions that are likely to have a negative impact on people who may be voting for them in the next election. And if you look at where the coalition's sitting in the popularity stakes at the moment, it's unlikely they're going to do anything to upset voters in the near term. So I don't think we're going to see many changes there. If in the unlikely event that they do make some changes, I think they're probably going to be directed at much younger people who can't really access their super anytime soon, and they're not going to change their vote because of those changes. So I'm predicting in the budget there won't be any significant changes to super this time around. Moving on to interest rates. Interest rates have stayed the same for the last couple of months. I still think we're probably due for another cut, probably in May or June. I think we're going to see a period in the years ahead where interest rates are going to be lower than they have been in the past 20 or 30 years. The reason for this is there's so much debt out there that if the Reserve raised rates to 5-6% as the reserve rate, which would mean in mortgage rates of 7 or 8%, there would be so much damage to the economy that we'd go into a very deep recession. So I don't see that happening anytime soon. I think the new normal is going to be lower rates moving forward, but eventually they are going to move up from these levels, but I expect them to stay low for the next foreseeable period, another year or two at least. Markets have been trending sideways a little bit after having a fantastic period throughout the second half of 2014 and the start of 2015. There's not a lot of impetus for markets to move up right at the moment, so I think we're probably in for a few months of just stability or perhaps a little bit of range trading. Currently they look fairly valued. There's nothing that's a screaming buy, I don't think, in terms of overall markets, but they're reasonably good value. The big problem around is that with rates being so low, there's really not too many options as to where you put your money. So if you can go into equities and get a good dividend stream, or property and get a good dividend stream, which is a bit harder, or rental stream I should say, a bit harder in property than it is in the markets, there's not too many other alternatives. So I think equities are still fairly reasonably priced and probably set to move higher over the medium term. Residential property I'm a little bit concerned about. I just can't see a valuation that makes sense on the current rates. The Australian economy is still bubbling along, still in a bit of strife. The mining boom is over, but we're going to be shipping a lot more than what we have in the past, so even though prices are lower, volumes are higher. So that's not too bad for the Australian economy, but it would certainly be better if prices were a little higher. You're probably going to see in the iron ore sector some of the smaller producers dropping out of the market, and that may help somewhat to reduce the supply-demand imbalance. That's about all there is for this month. I look forward to the next presentation in May.